partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast number 330. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. Axon Tire would like to give all the loyal listeners of the Moving Iron Podcast a free Alliance flashlight and a free Alliance baseball cap. If you like those, send an email to marketing@axontire.com and they will make sure to get that to you in the mail. Also, if you're planning on attending the Moving Iron Summit coming up here in Nashville, Tennessee, Axon Tire is going to cover the first $50 of your registration fee for the first 150 people. So check that out too. If you're interested in doing that, you can register at movingironllc.com, or you can send an email to me at movingironpodcast@movingironpodcast.com, and I'll get you taken care of. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs at Valley Transportation. Our goal is to help you reach yours. Powered by Farm Credit, Ag Direct is built for today's agriculture with simple application, quick response, competitive rates, and generous, flexible in terms. Ag Direct offers buy, lease, and refinance options for almost all types of new and used equipment, non-recourse and timely funding back to dealerships, plus sales incentives. No other ag equipment lender works like Ag Direct. Learn more by calling your Ag Direct territory manager at 888-525-9805 or visit us at agdirect.com. Tractor Zoom has access to over $20 billion in heavy equipment sales data. Tractor Zoom's Iron Comps is the industry's trusted solution for transparent equipment values and auctional pricing insights. This podcast is brought to you by Anvil AppWorks. The Dealer Connect CRMI app with integrated inventory management is an affordable Salesforce-based solution for your dealership to create connected customer experience to transform how you work today. I have got Rich Possum back on here talking about what's going on in the economy. Rich, how you been, man?
Very good. Thank you.
So I've had some news come out here since the last time we talked. We had obviously the Fed met and decided what they're going to do there. And then you had a very interesting statement from Jay Powell when he came out. I think it was yesterday I read, and I'm grossly paraphrasing this, so bear with me here. But basically, he said with the strength of the with strength of the economy when it comes to employment and how that is all playing out, that this inflation issue is going to be a lot harder to tame than they had originally thought. And now, of course, I'm paraphrasing that. So I guess, Rich, as you're looking at that statement from Powell, what you've seen the Fed do, where they've made some points to state that, yeah, we're going to lower the rate that we're raising rates, slow that down a little bit, but we're not dropping rates anytime soon. That statement to me makes it sound like they're going to maybe go back to saying, instead of being 0.25% raises, maybe we need to be looking at 0.5 and 3/4 again.
They may. And again, it just depends the pace of inflation declining and whether or not they want to get nervous over the strong jobs report. The jobs market is just fantastic for employees. Okay. We've seen good wage increases. That appears to be peaking and calming down a bit. I think the Fed likes that, but the number of available jobs concerns them that the economy is still running too strong, too hot, and can lead to supporting inflation. But I really liked what Powell said last week when they raised 0.25 point. He could have come out afterwards and really declared war yet again on inflation. And he really didn't say that. And the stock market liked it. The stock market moved higher. Yesterday, we saw some wild price action in the stock market. Powell was giving a speech. I forget where. It was like some kind of conference or something. And he came out and he said, yes, the strong jobs does suggest that they'd have to continue to raise interest rates for a while, and does suggest that even if they stop raising, it's going to be quite a while before they drop them. But that's about all he said. He didn't really imply they're just going to pound away at inflation, or I'm sorry, at interest rates, shoving them higher. And the market really liked it. While he was talking, the market exploded in a matter of minutes. I mean, it moved up as much as what used to take a couple of days. And the computers just basically kicked in. The day traders, they just stumbled all over. So I couldn't believe it. I was watching the quotes and it just kept going higher and higher and higher. Well, then they calmed down and they brought it all the way back down with the realization that what he was saying is we're probably still going to raise rates. However, by the end of the day, even though they brought it all the way down, and that scares people when they see that, if it goes straight up, straight down in a single day, they call that a sign of weakness, actually, even though there was good buying earlier, and they get nervous there's something breaking down in the market. However, going into the close, the market went all the way back up yet again. So just a very wild zigzag market, and we got decent volume for the day, decent demand is how my model summarizes it. So I think you had all that wild, crazy trading up and down during the day, but by the end of the day, I think you actually had long-term investors coming in there saying, we'll take some stocks. And why is that? I think the long-term investor is starting to realize they need to be less concerned of what Powell says, because Powell, his speeches actually impact the market more than raising interest rates. And I think there's a decoupling going on where people are saying we got to worry less over inflation, we got to worry less over interest rates, and focus on the idea strong jobs. What is it? Thousands of new businesses being launched, businesses that have been in business for a while, making good money. Yes, some of the profit margins are eroding, but good money. And I think they're just realizing stocks are a little on the cheap side. At least they need to catch up. It's like a weight needs to be taken off and allow the market to bounce back up some. So I was very pleased with how the market's handling it. However, on the interest rate side, we did see interest rates up at first in the day, and they sold stocks. Then the interest rates started to ease back, and my model was saying there should have been an easing back, and it was right. But by the end of the day, they put the interest rate back up, but then they also bought the stocks. So there was some of that decoupling I just spoke of. I think interest rates probably will work higher into next week on a very short-term basis. The question is, will they really ram them up? I don't think they will. If they do, it's going to bother the stock market. If they don't, I think the stock market's saying, look, the Federal Reserve isn't going to raise to late March again. And I think the stock market's betting to only raise it a quarter point. But Powell warned that he thinks inflation, interest rates, everything's going to have bumps in the road. And he's just saying this could be a long, drawn-out process yet. And if we do get a bounce in inflation, and I was a little concerned in recent days that some of these daily calculations people are doing, inflation was starting to move, that the inflation was moving up. This morning, it looks like it's starting back down again. But I don't doubt for the rest of this year, we can have scares where inflation suddenly picks up its head and interest rates then move higher. The dollar index moves higher and the stocks move lower. But I think we're in some kind of transitioning where the bear market in the stocks was over last year. I'm bullish this year. I think we're going to have a good up year. But I think there's going to be scares along the way. And it always fluctuates day to day anyways. We're still going to get that. And I don't doubt that we can see pops at times of inflation. But for the moment, it does look like the trend is down. And at least Powell last week and yesterday said, and he hasn't said this yet since we started this whole war on inflation, he just said there's evidence we're winning on inflation. And that's encouraging some people, at least over in the stock market. And I think if you look at the economy where we're going here, I just called a bottom in the Eurozone economy. Now that's off my favorite indicator. And sometimes that indicator has to move up before you really see the evidence of the economy doing better. And I could be premature. There's risk of being early yet. But I think the U.S. is the next one that's going to recover, and other pockets of the world. And I was just over in Portugal and very impressed with how business was going and with the people, and their level of education, how well they spoke English. I've never been in a country that had so many people speaking English, and they can speak it just as well as their own language. But it gave me a clue that I'm on the right track here for Europe. The Russia-Ukraine thing's still going to be a problem at times, I think, but hopefully it'll be resolved this year. But I would say, in general, Eurozone economy is going to move forward, even with the Russia-Ukraine thing causing some complications here. And,
Yep.
So to me, I look at U.S. exports, imports. The dollar has been beaten up well, and I think it's going to stay down. I don't think it's going to be able to move up in a sustainable manner for a long period of time, for a while yet. And I think it's going to boost our exports here. Not by huge amounts. It is possible the first half of this year things improve, but it's kind of like a slow curve up, and then things speed up later in the year. That's how I view China too. It may be a slow start, but
I have a question about that real quick. So
Yeah.
yesterday I was reading an article about getting ready when I was talking to Sean Hackett, and one of the articles I read about was how China and Brazil were going to have a clearing, export clearing in the yuan. So looking at that, I mean, they're saying like, okay, we don't even have to worry about pegging this to the dollar, changing money in dollars. Now we're both going to agree that I'll take your reals, you take my yuan, and we'll work this out together like that. So that was my question about the dollar. Is, I mean, you've heard about this whole baskets of currency thing, and when it comes to buying oil and everything else, I mean, for years, and that's just something we're starting to see. I mean, hit on the dollar a little bit more there, and your thoughts there. This obviously this would be great as the dollar devalues a little bit, goes down in value a little bit. Our exports are going to really have a very competitive situation in the marketplace. But I guess that kind of scares me a little bit when I start hearing countries do stuff like that.
Yes, and it's something we're going to deal with the rest of the century here. Is I think you got China and a couple other countries that are doing their best to get a bigger piece for their currency. Do keep in mind the Brazil-China relationship here. China's currency is pegged to the U.S. dollar, but there is a range to it. It's not a perfect thing, and they can modify it. But I think it was an easy decision for Brazil and China to say, and I'm sure China pressured them on this because they want their yuan being used around the world. They want to gain more power in that aspect or perspective. But really, if you're dealing with a yuan, you're almost dealing with a dollar. Okay, so I don't know if that's a sign of a major shift away from the dollar in terms of impacting what our products are worth.
Right.
And the same for Brazil, even, because there's still that connection between China and the U.S. However, and I think we've discussed this in the past. I do think when I look out like 100 years, I think the dollar will become less popular around the world. But unlike some people think it's going to happen any day now, and it's just going to be this massive drop in the dollar, I don't see that, and history doesn't show evidence of that.
There's too much of an unraveling there to make that happen overnight.
Yeah, it's and then it's just people who you can just see they want to trade in the U.S. dollar. I mean, it's a huge. I mean, I used to work for some of the biggest grain companies in the world, sitting next to all their import-export traders. The interesting thing is we seldom actually talked about the dollar. I talked about the dollar more than they did on my morning comments of where I thought markets were going. And but the point is, it's like in the end, everything gets priced by dollars. So you got a lot of work to accomplish that. Evidence that maybe that's working, and a problem would be the dollar index, which is still over 100. So you got to bring it down. I think you got to bring it down to like 75, which we haven't seen in decades. It's been a very rare thing. You get the dollar down to 75, I think that sends a message. Not only we have problems, but the world is also changing where it just doesn't need our dollar. And then that's going to create problems for future generations because we won't be able to print money so easily.
Right.
And but I think we're long ways away from getting to that. But I do think we're on a trend towards that. So I fully understand why people do get concerned about it, and they're discussing that. So
So before we started the podcast, we were talking a little bit about interest rates and with you being pretty heavy into real estate up there in New York, you kind of looking around, Rich. What are you seeing as far as how real estate's going? What are you seeing from a national perspective? How are you seeing interest rates inflect? We did see a dip in interest rates here. What was that last week? Whatever, it was dropped below down like the low 6 or something like that to the 5s, and it hadn't been there in whatever 3 or 4 months or something like that. So I guess looking at those situations and in that scenario that I just laid out there, Rich, what are you seeing in that? How do you see interest rates affecting that? And do you see, because I'm still watching, land in Iowa sell for 20 grand an acre, or more, so it doesn't seem like that's hesitating anyone from jumping in the game. We're still selling houses and stuff like that, nowhere near as fast as it used to be by any means. But I guess so. Looking at all those things, Rich, what are your thoughts on the real estate market and how is interest rates impacting that?
Yeah. Locally, I would say interest rates really haven't caused any significant change. We definitely see things have slowed down. There's less transactions. There's less deals being done, more so over in the houses than land. And on my end of the real estate thing, I concentrate more on land and farms and recreational properties. But even though we're not seeing a major impact, there's definitely brokers out there tell me that, man, it's really slowed down over the past 2 years. They had to work 7 days a week. They just did not dare stop. It was that brisk. And some of them haven't done much of anything in the last 30 days that they've spent the most time sitting at their home office than in a long while. So you see that, but yet prices really haven't come down much here. We're still getting deals done. There's increasing discussion of interest rates. However, when I look at the national numbers, the whole bull move over the past 2 years, it's over. And prices are coming down. Sales are off. And definitely the interest rate inflation thing really hit the market. But you also see from week to week, you get this pockets, just like interest rates dipped last week and suddenly, hey, 18% more mortgages done.
Yeah.
And so people are watching the rates, are hoping to lock in a rate so they can go ahead and purchase and this and that. And we're just adjusting to these higher rates. Like if anybody says, well, I'm waiting for mortgage to go down to 2%. Well, good luck with that. Okay. It's
right. Yeah.
That ship has sailed. It's over. Okay. The whole 40-year downtrend of interest rates is over. And it may go up for the next 40 years for all I know. I think it's only going to be up for 20 years, and I don't think it's going to be anything like what we saw in the 70s of very high interest rates. But I do think things can work higher in coming years on interest rates, and inflation can be somewhat elevated. I don't want to scare people. I don't think it's going to be anything like the 1970s, but at the same time, you can see things have changed. And we're doing things differently than what we've done over the last 20 to 40 years here. But what did we do in the 1970s? I mean, my dad, he ran a real estate business for 60 years. He still sold plenty of farms in the 1970s, even with the very high inflation and very poor margins at the time. Even though we were selling milk at record prices, the input costs were so high, we really weren't making any more money. But at the same time, and the same thing in the beef market, the grain markets, but business got done anyways. The wheels of commerce continued to turn. And that's what we have to recognize, that these higher interest rates aren't really a sign things are going to crash and burn, fall apart, by no means. And people are going to learn to pay these 5 or 6 to 7% mortgages. Locally here, we've heard of mortgages going as high as 11%, but yes, they have backed off here in recent days here. So I think things calm down here moving forward, but yeah, it's not going all the way back down in interest rates until maybe at the end of this decade, when I'm still forecasting what I call a primary cyclical recession. And I think land prices take a hit. I think commodities take a hit. I think everything takes a hit. It's just debatable. Is it rather moderate or is it serious? And the model is showing, boy, it can be all of that. Okay, it can be anything. It can be severe, and yet we might coast through it fairly well. But it is something to be concerned of later this decade. But right today, I realize some people aren't used to this kind of news we've had here in the past couple of years, and the high inflation and rates, and I'm sure they're worried about the future. But my modeling is saying we've done this again and again and again and again. Life went on anyways. The stock market went up anyways, and the economy grew anyways. And I think we're going to see the same thing.
Yeah, I made that comment the other day in the meeting. We were talking about something, and we were like, how are we going how are we going to combat this change in interest rates and buying culture and those kind of things, and how are we going to get stuff back to the way it was? And the comment I make was, time is how we're going to handle that, because this time, in 6 months from now, when we're having the conversation about 7% interest rates or whatever it is, I think the shock factor of that will be away, because that's just what we're doing now, and I think that's going to have a bigger play in the economy than lowering of the interest rates. It's just it moves so quick, so fast that it went from, you go get a house loan for, I think my house loan I have like 2.75% or something like that, and I bought a house 3 years ago, something like that, to where now I go buy a house today and I don't even know what I haven't even followed interest rates what they are, but they're 5.5 to 6.5%, depending on what it is and what you're looking at. So that's a huge amount of money, where the housing market was propped up by the fact that, well, now, you can pay this extra amount for the house because you're only paying, 1.9 to 2.5, 2.7% interest. Well, now you have to, that amount of interest that you're paying on that note starts to affect your payment in a big way. So people are now stepping back and taking a look at, like, well, I can't afford a $350,000 house, $400,000 house. Now I can afford a $250,000 house. And I think that's that shock factor is having a bigger effect on there. The people that you're talking to, when you're talking, the customers that you're dealing with, how much is that coming into the conversation? And do you hear people kind of talking about that in the background?
Little locally.
Really?
It is fascinating. It hasn't hit there yet, but again, we're dealing more with lands and farms. It always takes longer to sell it. It's not a fast market anyways.
Right.
But I'm hearing from brokers who focus more on housing, and like I say, they've really slowed down. And but it seems to be outside of our areas where there's a greater discussion of that. And going down to New York City, you have places that were selling for 3, 4, 5 million. They're selling for 1 or 2 million. I mean, it's that big of a drop because people, it happens so fast overnight. You go in to see the banker, and the banker says, "Okay, this will be your payment." And you're like, "Whoa, wait a minute, not so sure that fits with my monthly budget." And And the market's going to respond to that. You can definitely see, as a nation, we're backing prices off to try to compensate, offset, counter this rush up in interest rates. But at the same time, if people are thinking, boy, this is just going to be bad for a long time, history doesn't really show that. Eventually, somehow, we get the right price level of the house to match that 5 or 6%, right?
Mm-hmm.
And if we are making good money on our job, or even hopefully getting a pay raise or something, you become more comfortable. And if the stock market goes up, it's fascinating. It changes people's attitude, where, all right, I guess I can pay that now,
Yep.
And so we'll get through this. This is why I see the negative factors. I understand why there's people out there who think everything's just going to crash and burn any moment. But if you look at the history, their timing is off. I think my timing is right. That life goes on. So we'll get there.
Yep. All right. So looking at jobs report came out last week, and you had a really big shock there in the amount from what the market thought they'd see, and you saw a big move there. And as far as what that looks like, more jobs showed up than what they thought, but still the wage, I don't remember what that's called, but the wage differentiation between, how inflation's gone up compared to how wages have gone up, still has pretty much stayed the same. So taking a look at those two factors there, where more jobs popped up than we thought, but the wage to inflation ratio, whatever that's called, is actually going backwards a little bit. So I guess, how do you think that affects the economy, and what are your thoughts there?
Yeah, so even people have seen some wage increases. Some of them will say, but I'm still behind for what I'm spending at the store. Okay. And I get that. But I don't think it's for everyone. Okay. It depends on who you're talking to. Where do they live? How much are they getting paid? What are the class of society they in? Overall, I think we're going to see that kind of balance out. As inflation keeps coming down, pretty soon people are saying, well, I can breathe a little easier. And the thing is, those who got the higher wage increases and those who got a new job, but the job had to bid up more than normal to get it. So they got their new job, but they also got the pay increase. Those pay increases don't come down immediately just because inflation comes down. They normally don't come down at all.
Right.
And so the company's locked in. So down the road, as inflation eases, people will get used to current prices, and they got that new pay thing. So over time, it just doesn't, psychologically wise, it doesn't bother them as much as it did. Today, it bothers them when you're looking at the wages and the price increase. But I must say, even as I travel around the country, and now that I visited another country, even in Portugal, they were talking about the concerns of where is inflation going, costs going, and yet their food was cheaper than ours, and yet Europe supposedly has always been more expensive than us, and I just didn't see any evidence of that. I just think we're probably going to hit a moment here where the consumer is going to feel more comfortable what has occurred to them at the store, as well as what they're getting here for increased pay. Now, what's bothersome to like someone like the Fed is they don't want to see this increased pay just hang in there. The people just keep getting raises after raises after raises. Then it turns into like 1970s, and nobody really wins in that scenario. But I would say how I look at the average hourly increase here in these recent reports, there is evidence that's calming down, that the companies are being cautious. How much more do they really want to pay? How often do they want to get pay raises? I think that's making the Fed feel a little more comfortable. But at the same time, we still have the strong jobs. Now, we may see, there's already some discussion in some of my circle here of all the people I'm affiliated with this morning, all of a sudden a surge of discussion that we may see some adjustment in these job numbers. There could be some seasonal factors that occurred there. It won't take away all of the big surge in jobs. And by the way, the analysts and economists, they really got it wrong. I mean, it was a huge report. There was just a ton of jobs coming in. But we may see that's going to be adjusted lower here in coming months, or even the next couple of quarters even. It might have been a little bit of fuzzy stuff going on there that can occur, just the math and how things are reported and the time of year. But it's not going to take it all away. I mean, the bottom line is there's plenty of jobs out there. And this is like, I think the Fed's changing its attitude, not going to beat us up too much here from this rising interest rates. But I hope they don't get so obsessed with the strong available jobs, which is called the JOLTS report. We're back up to 11 million jobs available in theory. Sometimes they think a lot of those jobs aren't really there. Companies just put them out and go fishing and this and that. And of course, some of those jobs are so low paid, nobody's going to take them anyways. But the numbers there, it's strong. But I hope the Fed does recognize the fact that we've seen people take early retirement like never before. And the virus pandemic should change people's attitudes. You know, hey, I just soon be retired and not show up to work where I'm going to catch something that's going to kill me. So, and then that may be an oversimplification there. But granted, some of those people are, what's that?
I don't think you're that far off.
Some of those people are coming back to the workforce because they're learning they don't like unemployment or being retired. And some of them also learn, well, the stock market just went down and kind of beat up my retirement, and things aren't quite the way I thought. But overall, this is normal anyways. The baby boomers, one of the biggest populations per generation, they're old enough to retire, and so it's going to happen anyways. I think that's going to keep the labor market tight for years, okay, for the next couple of decades. Fed's going to have to learn to adjust to that. And I think maybe they are, but that is something that could go wrong for myself on some of my optimistic forecast here, that if they decide we got to knock that jobs down a huge amount, no, they should only knock it down a little bit. And so we'll see. I think the Fed still stops around 5.25%. One of them yesterday come out and said he thinks 5.4. I don't know if the market really wants to see that, but it's something to think about. And by the way, today we're probably going to have at least 3 Fed members, maybe 5 coming out and talking today. So we'll see if they want to be a little more negative than what Powell showed us, because Powell was interesting. I mean, he was basically saying the same story. We're going to keep raising interest rates. We're going to keep working on this. But unlike all the other times, he said, well, we've accomplished a lot. It is working. And for me, that's what I wanted to hear, even though it's not everything I wanted to hear. and we do have a ways to go. And I follow a daily inflation called Trueflation. I think it's actually app, trueflation.com. And True is just TRU. But they put out a daily inflation number, and I think it's pretty good. It's now more important than a lot of my other sources here. But it did make me nervous last couple of weeks. It's like it stopped going down. And so I think in March, when we get February's inflation number, we might be a little disappointed it's not dropping fast enough, but the trend is still down. And it did turn down this morning at least quite a bit. So maybe we're okay. But I think next week on Tuesday, we're going to get the January inflation number. And I'm hopeful it's 5.9, but I don't consider myself a good forecaster where that number goes. It is tricky. I think if it comes in at 6.2, the market's not going to like it. I don't know as the market knows what to do with a 6.1. 6, I think it's probably okay. And if it ever came under below 5.9, stock market's going to jump. And but we'll see. I'm not concerned whether I'm accurate on that. It's just another input here.
Right.
And it's going to take a while. I agree that some people want 2% inflation before the end of the year, and some of them truly believe we're headed there because they got things saying the government is so far behind on this. It's much lower than everybody thinks. I don't know if I really buy into that though. And I could see 2% is going to take us next year, maybe the early part of the following year. That could be a pretty slow decline. But as long as it's just eroding, I think it's just like unemployment when I teach people how to be cautious how they view unemployment to the stock market. Once a decade, we explode unemployment. We have a recession. It's the end of the world. And then we wake up, no, it isn't. And we go back to work. And we start adding jobs, but we add jobs slowly. It might take it 8 years to get down to where it started from, right? And I'm talking on the percent unemployment. This time is different. That virus pandemic really set up something different where we're already back to the lowest in 50 or 60 years or something like that for unemployment, and it makes it tricky where we're going. But in general, if you looked at unemployment, yes, it eroded for 8 years, and guess what? The stock market went up for 8 years. I'm kind of thinking the same thing in inflation. Even if it's coming down slower than we want, as long as it's going down, even if it takes it 3 years to get to where everybody wants, I think we're going to find the stock market went up there in those 3 years. I may be wrong, but that's how I'm approaching it.
Right. Yep. Okay. Last question here. So when you're looking at all the stuff that we see happening with what's going on with grain, with the way stocks are, ending stocks are with grain around the world, see a pretty big crop coming out of Brazil. You got the stuff still going on in Russia, Ukraine. If they said had a ceasefire tomorrow, it's 20 years before any of that stuff gets calmed down, because there's still going to be pockets of this, that, and the other thing that are going to be popping off here and there. Taking a look at some of the projections that Sean Hackett's talked about going into 23, where we're looking at some pretty serious possible drought issues that we could see happen, where the El Nino hasn't quite flipped over to La Nina hasn't flipped over to El Nino yet, and various other things that come into play. I guess as you look at your models for grains, what are your thoughts there, and how do you see, what's your prediction, I guess, going into 23 for how grain market might look moving forward?
I think things are still tight enough. Some people say nah, but I just feel like it's still tight enough. More so soybeans than corn, wheat, but I'm lumping all three in the same basket. That I think you get a seasonal up move in prices. Normally, grain prices fall from May, June, July into October, and then they normally climb back into June, July. Okay, I think we're setting up for that just by looking at that study alone. But as I throw these business cycles in, where things get more emotional, how much are people going to really pay for things? It's also saying we got a chance to move these prices higher into summer. And when I throw in the climate model and the droughts and the crop problems, the business cycles are saying you definitely have to leave the door open. We have a crop problem and get even a better bull run into summer. Problem is, the climate model is saying, well, it can actually happen this year, it can happen next year. And as I look at the prices, what's the market thinking? The market already knows that. I think the market feels something's coming. but it's not sure what year it's coming. Okay. And so I think people are going to err on the side, okay, let's assume a little better prices in the summer. We get the crop problem on top, then prices explode. If we're already in, hey, we make an extra buck out of it. And so I'm not so sure we have aggressive people in this market betting on a crop problem this year. I think they just realize the possibilities.
Yeah.
And to me, we do have to keep an eye on La Nina. If La Nina goes away, it's unlikely we'll have a significant drop in yield, and I would have to assume it's probably going to be next year, and that's a dilemma I have. It's either this year or next, and I'm going to be flipping back and forth probably every week here on it. I just have to leave the door open that it can occur this year, but I'm not so sure I see everything I want. Even in the western half of the U.S., it's been drought for a long time and very unusual. I haven't seen anything like that in my lifetime. However, in the last 2 or 3 weeks, we can see pockets through the center of the western half where it's suddenly no drought. It's back to normal already. So that may be a sign it's just not coming this week or this year. I mean, but again, I'm going to err on the side of giving it a chance because I look at the soybeans. Granted, Brazil's probably going to produce a lot of beans, but Argentina just got hammered. Okay, they got damage. It's not coming back. Brazil will probably open up, or I'm sorry, China will open up here this year, but I'm not so sure they have to step up to the plate right away and buy huge amounts. So that's a tricky one. So you get this little bit of a mixed picture. But on balance, it still looks like strong enough demand to support these prices in the summer. And it's just that gamble of adding a crop problem or not on top of that. And,
right on. All right, Rich. Well, talk a little bit about your podcast, because the stuff you're talking about here, you talk about on that podcast and way more in depth than what we hit here. So talk about what your podcast is and where they can find it.
Yeah, so I put out morning briefs where they're audio or video, and I try to keep them 5 minutes audio, 10 minutes video. Twice a week, there's definitely video instead of any kind of audio. And one of those is my weekly update, which can get long. It can go 30 or 40 minutes, say for the grains, and then it can go 30 or 40 minutes for stock market. But I have a separate service. Well, it's all one service that you pay for, but it gives you audios and videos on the stock market model, including interest rates, gold, crude oil, the economy, dollar, a variety of things. But the primary focus is on the stock market because that's where most of my people are interested in trying to make money. And then businesses like it just because they want to hear what I have to say on the economy and where business is going. And then there's the grains. That's basically just corn, wheat, and soybeans. I keep it pretty simple these days. I used to study 30 commodities, but over the 20 or 30 years of doing this, kind of swung to simplifying that. And so the service, they can go to criticalpointpod.com and they'll find about myself, the models, and then there's some links to go see some of these videos and audios and to subscribe to the service there. And that's the gist of it. And like I say, some people focus just on the weekly updates, and others, they like to check in on the morning. And I always tell people, if they're concerned too much information's coming in, focus on the weekly. But if they ever see anything that I put up that it says alert and it's a market they're interested in, they better take a look at it. And it may be a signal that's just short term and they don't care, but it may be something quite important.
Right.
And how my model works, it basically labels and catalogs all price fluctuation from intraday all the way to years. And it's just updating us throughout the year. It basically gives us an idea how the market's fluctuating throughout the year. And once you've seen it, followed it for a while, you say to yourself, gosh, we have to keep this to give us an idea. Because sometimes you'll see a signal from someone and you'll later say, I didn't really need to do that. And you may recognize that saying, the signal I give you isn't that important. But if you follow it anyways and see that it actually worked, then when you get the signal you need for your business or your investment or your retirement portfolio, it's going to give you greater confidence to say, best take that signal. So,
yep. Right on. Well, Rich, I appreciate you being on the podcast, man. I love it when you come on, your wealth of information and you give the contrarian thought process to what I hear. All I hear on the news anymore is that we're on the verge of death here, and might as well start eating pork and beans, because that's what we're going to be doing.
I see it too, and it doesn't make it easy on me, but I've also done this for probably nearly 40 years now in the markets, and a lot of my things have been tested for the entire history of this country. And I just realized some of those people, they really can't be right until they get in alignment with these business cycles. So people are thinking stock market 40 or 50, 70% down. There's like almost 0% probability in the next few years that, however,
Right.
near the end of this decade, we need to have a discussion where they may be right, and hopefully I'll be on board with them, and we're all right, and we save ourselves.
Right. Exactly. All right. Well, Rich, I appreciate you being the podcast, man.
Okay, thank you very much.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC, on LinkedIn at Moving Iron Podcast, and go check the video version of this out over on the YouTube channel. That is the Moving Iron Podcast YouTube channel. Go to Moving Iron LLC for everything Moving Iron related, and to sign up for the Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th. You can do that by clicking in the upper right corner on the 2023 Moving Iron Summit tab, and you'll get that information there as well. Take advantage of that $50 discount from the folks over at Axon Tire. So with that, I'm Casey Seymour with Rich Posson, Exclusive Iron folks. Out.
Moving iron in the 21st century. Hard work.